If your city runs disaster drills, you pack water, batteries, a flashlight. But your money? Most of us never practice for the financial disasters that actually arrive. The surprise 1099 from a just-for-fun side gig, the year-end bonus that shrinks on contact with reality, the investment win that turns into a tax bill 6 months later, the envelope that says, "We selected your return for examination." Start with a warm-up, your tax seismograph. You have two numbers that predict how hard a shock will hit. Your marginal rate is the percentage on your next dollar, the cliff edge where a bonus, a freelance invoice, or a capital gain will be taxed. Your effective rate is your actual average for the year. People confuse them, panic at the average, and undersave for the marginal. Your drill is simple. Look up your current marginal bracket for federal, add your state if you have one, and if you're self-employed, fold in the self-employment tax. Tape that number to your monitor. Every extra dollar sits under that cloud until proven otherwise. Now the siren sounds. Scenario 1. The side hustle quake. It starts quietly. You sell presets on Gumroad, do 3 design gigs on weekends, drive some rideshare hours to pay for a gadget you couldn't justify. In January, a 1099 shows up, maybe from the platform, maybe a 1099K because your payments crossed the reporting line, maybe nothing because the platform didn't issue a form at all. Tax law doesn't wait for paperwork. If you earned it, it's income. The tremor you feel is the absence of withholding. Employees get tax skimmed out of every paycheck. Side hustlers don't, and that's why the ground moves under new freelancers in April. Here's the drill you run the minute money lands. Sweep a percentage to a separate tax bucket. If you have no state income tax and you're a sole prop with modest profit, 25 to 30% is a sane first pass for federal income tax plus self-employment tax. Add 5 to 10 points if you have a high tax state or you're well into mid brackets. Don't guess wildly, anchor it to your marginal rate. If you think your side hustle profit lands in the 22% federal band and you owe 15.3% self-employment tax up to the Social Security cap, you're nearly at 40 before deductions. Yes, business expenses lower that. Yes, half of self-employment tax is deductible. But the drill isn't to build a dissertation. It's to sweep aggressively, then enjoy the refund if you overshot. If you think your side hustle profit lands in the 22% federal band and you owe 15.3% self-employment tax up to the Social Security cap, you're nearly at 40 before deductions. Yes, business expenses lower that. Yes, half of self-employment tax is deductible. But the drill isn't to build a dissertation. It's to sweep aggressively, then enjoy the refund if you overshot. You also start a tiny ledger. Revenue in, business expenses out. Save receipts like a boring champion. Software, gear, mileage logs, a portion of your phone, the microphone that makes your voice not sound like you recorded in a bathroom. The rule of grown-ups is ordinary and necessary. If it's common and helpful for your line of work, document it and move on. Once your quarterly looks real, roughly April 15th, June 15th, September 15th, and January 15th, you make estimated payments. Safe harbor math keeps you out of penalty weather. Pay in at least 90% of the current year's bill or 100% of last year's, 110% if your income was higher. If that sounds like algebra, automate it. Same day you get paid, sweep to the tax bucket, then once a quarter send what the bucket tells you. Scenario 2, the bonus tsunami. Your company drops a $10,000 bonus. You do a little dance, then see the paycheck and wonder who else got invited. Here's what happened. Employers withhold on supplemental wages using special rules. Sometimes it's a flat supplemental rate, sometimes payroll blends it into your regular check and withholds like you earn that much every pay period. Either way, withholding is not the tax itself, it's a down payment. The real bill happens on your return and it's driven by your marginal rate. So why does a $10,000 bonus feel like 6? First, income tax withholding grabs a chunk. Second, payroll taxes still apply. Social Security and Medicare don't skip bonuses. Third, your state takes a slice. And if you were already under withheld for the year, that bonus check didn't fix the earlier gap. The drill here is 2 lines on a notepad. Line 1, what's my marginal rate plus payroll tax on that last dollar? If you're in a 24% federal band and pay 7.65% employee payroll, you're at about 32% before state. In a 5% state, that $10,000 is predestined to feel like $60,000 to $6,500. Line 2, what will my final return say? If your bonus arrives in November and the year's been good, you adjust your W-4 to increase withholding for the last few paychecks, or you drop a one-time estimated payment. You don't wait for April courage. You use December clarity. There's also a quieter move. Purpose the after-tax dollars before they hit your checking account. If debt is your tax on yesterday, kill it. If retirement space is still open, fill your 401k or IRA. If you're in a health savings plan, top the HSA. The fastest way to turn a bonus into resentment is to let it evaporate across 12 impulse buys. The fastest way to turn it into future relief is to aim it at buckets that either lower this year's tax or permanently shrink your lifetime bill. In a 5% state, that $10,000 is predestined to feel like $60 to $6,500. Line 2. What will my final return say? If your bonus arrives in November and the year's been good, you adjust your W-4 to increase withholding for the last few paychecks, or you drop a one-time estimated payment. You don't wait for April courage. You use December clarity. There's also a quieter move. Purpose the after-tax dollars before they hit your checking account. If debt is your tax on yesterday, kill it. If retirement space is still open, fill your 401k or IRA. If you're in a health savings plan, top the HSA. The fastest way to turn a bonus into resentment is to let it evaporate across 12 impulse buys. The fastest way to turn it into future relief is to aim it at buckets that either lower this year's tax or permanently shrink your lifetime bill. Scenario 3. The investment aftershock. You sell some stock because the chart looked like a ski slope, or some crypto because this time to the moon actually happened, or a rental because your patience ran out. The shockwave doesn't hit the day you sell. It hits next spring when you realize markets move by price and taxes move by paper. The question that saves you is savage in its simplicity. What's my basis? What's my holding period? And what's my band? Basis is what you paid plus certain costs. Sell above that, and the difference is your gain. Holding period decides the rate. Long-term, held more than a year, often enjoys a lower rate than short-term, taxed like ordinary income. Your band is where your other income places you. Long-term gains run through a 0, 15, or 20% federal ladder. Then state rules add their own layers. There are wash sale rules for losses, rebuy too soon, and your loss gets disallowed. And there is no wash sale forgiveness for crypto under many systems when you take a gain. A win is a win. The drill is to decide the tax before you spend the proceeds. If you realize a $20,000 long-term gain and sit in a 15% federal capital gains band with a 5% state, earmark $4,000 to the tax bucket immediately. If it's short-term and your marginal band is 22% federal plus state, earmark accordingly. If you're in the rare position where part of your long-term gains falls into the 0 band, map the calendar and harvest deliberately. Sell just enough to fill the 0 bucket this year, then consider selling more on January 2nd for a New Year's bucket. None of this requires genius. It requires pausing long enough to ask where the gain lands. You also practice a smaller annual drill that makes future aftershocks gentler. Each December, glance at your realized gains and losses. If you've had wins you plan to keep, look for losers you no longer believe in and realize the losses before year-end to offset the wins, staying mindful of wash sale rules. If you're perpetually nursing a giant low-basis position out of fear of tax, build a staircase, realize just enough gains each year to use your allowance or low band, then stop. You're not outsmarting the code. You're using the years it gives you. Scenario 4. The audit hurricane. Most people will never see a full-dress audit. Many will see a letter that says a third-party form didn't match their return, or a request for proof of a deduction. The difference between panic and poise is your go bag, the short list of things you can produce on command. You keep a folder, physical or digital, called tax proof. In it, you drop W-2s, 1099s, 1099K if issued, 1098s for mortgage interest, broker summaries with the detailed trade reports available if basis is missing, closing statements for any property you bought or sold, and receipts for the deductions you actually claimed. For meals and travel, you keep the receipt with a purpose note. Who you met, why it was business, what project it tied to. For mileage, you keep a log with dates, start and end, purpose. For home office, you keep photos and a little sketch with measurements. You don't save every scrap forever. The G, Narrow rule many advisors use is 3 years after filing for ordinary income items, 6 if there's a big understatement, and 7 for things like loss carry-forwards or bad debts. Property and basis records you keep as long as you own the asset plus the statute period after you sell. Crypto gets its own shelf because timestamps matter. If you receive staking rewards or airdrops, you record the date, the amount, and fair value at receipt. When you dispose, you record proceeds and fees and which lots you sold. The Go Bag isn't a warehouse. It's a curated kit that lets you answer, quickly, the question an examiner actually asked. If a letter does arrive, you mirror its headings. If it says, "Please provide documentation for X," your packet starts with X. Put the cleanest proof first, then the supporting statements that corroborate it. Where facts were messy but honest, write a brief explanation in plain language. You're not performing. You're making it easy for a tired human to say yes. There's a final layer to the stress test that ties all 4 scenarios together. Cash flow drills. You run them like fire drills. On payday, you sweep a fixed percent to a tax account you don't use for anything else. When freelance money lands, you sweep more. Each quarter, you reconcile quickly, 30 minutes, not a weekend, and send estimates if needed. In December, you run a mock return with the numbers you have, even if it's rough, to catch surprises while you still have a calendar to fix them. If you're due a large refund, you adjust withholding so you're not lending the government money at 0%. If you owe more than you can wire without a lump in your throat, you increase the sweeps for next year so this is the last time it hurts. You also pre-decide how windfalls behave. A bonus, a big invoice, a successful flip. Before any of it appears, you've written your rule on a sticky note. 50% to taxes and savings, 20% to debt, 20% to future you investments, 10% to guilt-free fun. Make your own percentages. The point isn't asceticism. It's removing the moment where your feelings negotiate against your plan. Your best friend in a tax disaster is not a spreadsheet. It's a system that makes the right thing the default. Set up email rules so invoices from platforms land in a single folder. Use a receipt capture app or a simple phone scanner into PDF with searchable text. Name files with date, vendor, amount, and purpose so a stranger could follow the story. Connect your bank and card feeds to bookkeeping software if your business has outgrown shoebox accounting. Automate HSA or retirement contributions so you never forget the benefits you claim you care about. If you hate tech, run a low-tech version. 1-year folder with 3 nests, income, expenses, taxes, and a monthly calendar reminder named Close Books, 45 minutes. You'll be shocked what that habit does to your heart rate.